Yeah, so that's great. So my unashamed goal as an investor, and again, people say, well, how can you do multifamily? And you're doing oil and gas, and you're doing car washes, and you're doing like, well, my unashamed goal, Mike, is to own everything and operate nothing. So that's why I want to like
Yeah.
invest my money and like not have to do. I mean, obviously, in my business, like we do, we communicate with investors, we educate. I have.
Hey, everybody, welcome back to another episode of The Richer Geek. We have Bronson Hill back. Last time we talked to him was probably last summer, June or July of 2024, I think. But we're going to see what's new in the world of real estate and, see if he's shifting his strategies based on the economy. We're in almost the middle of May 2025, and there's a lot of uncertainty in the world, as everyone knows. But he's the founder and CEO of Bronson Equity. He's raised over 20 million for real estate investments. He's a general partner over 150 million dollars worth of real estate around the U.S. He's one of my heroes. Bronson Hill, how you doing?
Good, Mike. Good to see you. It's always nice to talk to a good bald brother, the richer geek. If I can hang out with you, I'll just be a little richer and a little wiser. So I'm excited
Yeah.
to chat today.
Well, I think it'll be both ways. And someone just made fun of our logo, the Richer Geek, and they were like going, "Hey, that logo, the guy has hair." And I'm like, "Oh."
Well, there's
Maybe
there's that saying we feel good about ourselves, right? God made only so many perfect heads, and He covered the rest with hair, so
uh,
we feel good about ourselves that way, apparently.
there you go. So, for those that might not have heard your first podcast, tell us a little bit about yourself and how you got started.
Yeah, so up to some updates to my bio. I've actually raised over 50 million now, so it's gone up the last couple of years here. And yeah, so I was a well-paid sales professional. I worked in the medical field, so I did medical device sales. So I'd go into surgery and I'd sell heart surgical equipment. It was very interesting intellectually. I got paid over $200,000 a year. So there were a lot of things that were great about it, but the thing I did not have is I didn't have control over my time. And a lot of people will say, I want financial freedom. But really, for me, it was about time freedom, right? So a lot of people just that are in professionals, they just can't take time off. They don't. I worked with a couple of physicians. They made over $2 million a year each, but they couldn't take a vacation. Or they worked, when they were working, it was like 60 to 80 hours a week. And it just, to me, just felt like that is not freedom, right? So it's the idea of like, what does freedom really look like? It is freedom of time and to be able to cover your rat race and your other financial freedom numbers so that you can live the life you want. So started learning about real estate, did some single family, realized that wasn't getting me to my goals as quickly as I wanted, learned about raising capital, found a partners and a lot of things happened in between, but started raising capital for real estate. And then, we basically help people get cash flow appreciation and tax benefits. And so we've shifted a bit from real estate only. We're doing a lot of buying private businesses, which are very high cash flow. We're also doing oil and gas deals and provide ordinary income tax reduction, which is incredible. And also, you mentioned the idea of debt funds, real estate debt funds. So there's different ways. It's like as an investor, I think it's just so good to have a nimble approach where you not just be married to one thing, like I only do flipping or I only do multifamily real estate, as being, hey, I can do any asset anywhere if it meets my goals. And it's actually not that huge of a jump to jump from being a one type of investor to come into something else. So that's the advantage of being a passive investor is you have choices.
Yeah. And, talking about passive investors, people are sitting there right now. It's like, oh my God, the stock market, it loses 1,000 points, it gains 1,000 points. They're losing hair, and, I'm talking to people's, well, there goes my retirement. I'm going to have to now work another 5 years. And I'm thinking to myself, you don't have to
Yeah.
if you did some passive investing. So talk to us a little bit about what your investors are looking for now. What has changed over the past year or so since we've talked, the economy, interest rates, expenses. Where have you shifted your thought process?
Yeah, so we took a break from doing real estate multifamily till about last year. We started getting a little bit more, and then we've kind of like not that we're not doing it, we just haven't been pursuing it as much. Just because right now, and we talked about this kind of before we started recording, it's just that it's hard to have real estate deals. A lot of them make sense from an equity or a traditional investing standpoint, meaning, you mentioned whether it's operating a hotel or it's a multifamily apartment. What used to have pretty good cash flow. I mean, it was just like almost from day one, there was cash flow available. Now it's like, well, there's maybe a little bit, but there's all dependent on the value add, and the cash flow numbers are way lower, and there's just more risk involved. And so it's not that they're not. I mean, they're solid investments because people are going to we need more housing. So it's kind of this weird disequilibrium time where we have this incredible demand for this asset. We're not really building a lot more, but yet we're not seeing rents rise like we would think. And so this, things do spike and they go up and they go down. And so I think because of the debt costs, because of inflation, because of a lot of the tariffs, a lot of uncertainty around these things, it just caused the cost to go up quite a bit. And yet we're still not seeing rents rise kind of the equivalent level. So for that reason, we really, again, I wrote my book, Fire Yourself, which is in the background here. It's how to replace your working income with passive income in 3 years or less, became an Amazon bestseller. But really the goal of the book was really to take someone who's trying to solve a problem. So people come to investing because they're looking for cash flow. Cash flow is really what allows you to leave a job, to retire and actually fire yourself. And there's also appreciation or tax benefits. But the biggest one, I think the most powerful one, is cash flow. So we've looked into other things where we've been buying businesses. We had a large business deal we're planning to do, and the tariff situation with China affected that. So we decided to put that on hold. So it was a ton of work. It was some money out of pocket, whatever. But sometimes the best deal is the deal you did not do. So we're continuing to look for other business opportunities, oil and gas, other projects like debt funds that really provide consistent cash flow and safety. And so, but yeah, I do think, for a lot of investors, they're like, well, where do I put my money? Like, stock market's volatile, cash, you're losing money. Everything costs 50 to 100% more than it did 5 years ago. They can't say inflation is 3% or 5%. Like it's just substantially higher. So I think people are starting to become aware of this, that, I've got to do something different than what I've done before. And if I've only done one thing, I've got to kind of learn some other avenues that could be a little bit better. So we've been continuing to do that in our business as well.
It is very important for us GPs to start thinking. It's like you get in a rut. It's like, I only do hotels, I only do multifamily because that's what I know, that's what I'm good at. But when you look at, for instance, one of my hotels, first quarter this year, we've done $85,000 more in expenses,
Hmm.
same period last year.
Wow.
And nothing's changed. Our ADR, we're making more, but everything else has gone up so much, and free breakfast, the free this and free that, and it's just like, my God, the expenses are a real deal.
Yeah.
Compound that with interest rates, and it makes you pause, and especially as an investor, they're starting to see these things. Um, what kind of businesses are you guys looking at that you can say it's like, well, besides the tariffs and things like that, what are you seeing the type of business that you guys are going after that may be a little more recession proof, might be a little more cash flow?
Yeah, well, the interesting thing of buying businesses become a little more popular. There's people like Cody Sanchez and other people that are saying, hey, go buy a boring business and things like this. And from a cash flow perspective, I started looking at it from a cap rate perspective. So a lot of your investors are familiar with cap rates. It's if you own a property in cash, what percentage would you get per year in cash flow? And typically, I know it's higher in what your genre in hotels, but 5, 6, 7% is kind of pretty normal for hopefully for apartments, maybe 4%, depending on what market you're in. But these businesses we're seeing, they're selling for like 3 times profit, which is like a 35 cap rate, right? So obviously there are risks there. You have to operate them. There's things, and we're not talking, there's kind of a sweet spot. A small business that generates $1 million in cash flow or less is kind of one feel. It's kind of just a very small, more mom and pop thing. If you get over 3 or 4 million in cash flow per year and profit per year, then it's the larger private equity groups that are doing it. But there's kind of that sweet spot in between where you're paying, 3 times earnings. It's kind of amazing. So some of it's the size of the business, but we have actually really liked. I mean, there's many different types of businesses, but we've liked e-commerce in general. There's U.S. e-commerce and there's e-commerce where they ship products or services from overseas. Well, it would be products from overseas. So we've liked those because you'll have one business we were looking at that this is the one we almost closed on. 27 million a year in sales, no sales on Amazon. It was physical products. Drop ship from overseas, and there were only 3 full-time employees. Only 3 full-time employees. The rest, was the suppliers were third party. It was basically just getting the sales and supplying the orders. And this company generated about 5 million per year in cash flow, right? And this was a company that we were able to buy for 13 million out of pocket, and then there's a little bit of an earnout for the owners. But so when you see numbers like that, it's like that's really attractive. So we like the scalability of that as well. And Alex Hermosi, I heard him talking about this as well, is that if you have a company that generates 3 million, per year in earnings, it'll sell for 3 or 4 times the actual profit, right? It'll sell for 3 or 4 times. But if it's at 8 or 10 million in earnings, so you basically doubled or tripled the size of the business, it'll sell for 10 to 12 times earnings. Right. So you get this huge multiple on just simply having a larger business. And why is that? It's because private equity wants to buy more cash flow. They want to buy larger things. They don't want to deal with a $2, $3 million, cash flow type business. They want to deal with a $10 million. So it's amazing that some people will pool businesses together. They'll buy a plumbing business, an electrician business, and also buy, another. There's kind of some of the service business. They can package them together, and so those are things that people do. But I think it just depends on what you want to do. We've really stayed away from things that are like very high labor things, restaurants, other things like that, where it's just, big time labor, but things that are more scalable, that are a little less, that are also priced very attractively, we really liked.
Yeah, that makes a lot of sense. If you can make a gizmo or a gadget and it doesn't take, they've already spent, the money on the machinery, so you don't have to do that. And it just takes a robot or a couple people to take it off the assembly line. And then you just have to, so what's the goal is to build up the marketing, build up. Do you just go out and say, hey, they're not even online or they're not even
Exactly.
doing.
Yeah, so that's great. So my unashamed goal as an investor, and again, people say, well, how can you do multifamily? You're doing oil and gas, and you're doing car washes, and you're doing like, well, my unashamed goal, Mike, is to own everything and operate nothing. So that's why I want to like
Yeah.
invest my money and like not have to do. I mean, obviously, in my business, like we do, we communicate with investors, we educate. I have calls, we have our mastermind, we have all this, but like I don't want to be the one to operate. So I've got a partner who's really great in e-commerce, who's really great in email marketing. And so, for example, a couple of value adds we saw in this business that we were looking at, we saw this business had an email list of 3 million people, and they weren't really doing any affiliate marketing. They weren't doing any sort of other types of. So there are ways, and just this is just one example where you can take that list of emails, and maybe 2 million of those are active emails. Some aren't as active, but you'll say, let's create a newsletter. And there are groups that do this. They'll create a newsletter around those. This is in the beauty space, around those beauty products. They'll say, hey, here's some things you might want to know, whatever, and then they'll create links that have all affiliate products that are not competing, but they're kind of adjacent to, and they'll sell on that. And you'll find that you can generate quite a bit of revenue by putting things in there. So we saw basically potentially a 10 to 30% increase in profit year one just from simply implementing something like this. And there are other things like that in the business, but it's the same with real estate. It's what's the value add? What's the thing that you can bring that maybe somebody else isn't even thinking of? And so when you have different minds, and so my business partner and I, when we think about, okay, how are we going to do this? What can we do here? What can happen here? We're always thinking about what can we do to create more upside? Because it's great to maintain a business, but really businesses are kind of growing or they're dying. And so it's just thinking about how could we grow this? What's the value that we bring to it? And it's the same that we look at with probably hotels and apartments: is do we have the skills? Do we have the partners involved in the deal that can really help us to take it to the next level? But yeah, so I think that there's different things that a lot of times people don't even see, that you show up with your skill set and you're like, aha, like I see something that we can actually pay more for this business and make way more money because we see the upside here.
Now, do you try to go after the dying business, or do you want it to be, this is really performing
Yeah.
and I can go in and bump it up?
Well, this is a good question. So Warren Buffett is somebody I've studied for a long time. He just recently announced he's retiring from, after the age of 94 or whatever he has to
Yeah,
retire from.
I know.
He's going to stop tap dancing to work. But he would talk about when he first started investing, they did this value investing, which is he would go after he called them cigar butt businesses. So it'd be like one puff left in the cigar, but he'd do all this and he try to, and over time he adapted to say, let's just try to buy a great business at a fair price. If we can find a wonderful business at a fair price. So I think that really exists in the business world too. We had actually a deal that we looked at, we made an offer on, the offer was accepted. This was within the last 12 months, and we decided to not move forward on it. And then the person who bought it just absolutely got their butt kicked. Like I mean, it wasn't like we were just geniuses. We kind of smelled something, something doesn't quite seem right here. And I mean, almost from day one, this guy took it over. It's like the thing just tanked. So now the same business that he bought for $3.5 million, it's an e-commerce, US e-commerce business. He basically is selling it for 1.2 million. And this is less than 12 months later. So we looked at it, and this was actually a call we had this week. And our partner like, yeah, this thing just looks like a total crap show here. Like we like we could do this, but for the size, for the effort, for the amount of work, it's like I would rather. One nice thing is when you have scale. Same with real estate. When you have more scale, you can have better teams. Like the other business that we almost closed on, it was like we didn't, all we had to do was basically get the number of sale, like really work on the marketing engine and grow that. And we had some ways to do that. And then also just make sure that we can fulfill, or we have a third party group that can help fulfill the product. If you're having to do all that in house, which this other company did, it was like they're creating, fulfilling their marketing. It's like that's a ton of work, and it's a smaller business. So actually, that smaller business would probably be way more work than the larger business, just because
Yep,
of
yep.
the teams that are in place in the larger one. So I think sometimes bigger is better, and actually you get better loan terms. There's like non-recourse debt, and there's things that you get that are much better. Same with real estate deals. The bigger the deal, they say if you can't pay your mortgage, right, for a real estate a place you live, it's $300,000, $500,000 loan. It's your problem. But if you have a $10 million loan or $30 million loan, you can't pay it. Whose problem is it? It's the bank's problem, right? So sometimes
Yep.
bigger it can be better for a lot of reasons.
Absolutely. Banks don't want the business. They're not landlords, they're not operators. So I can see that. If it gets their attention, they're more than willing to work with you a little bit more than instead of just writing off six or 700,000.
Yeah.
And that's very interesting. So let's dive into Fire Yourself, the book, a little bit. What are people going to find? We've talked about how they can go for passive income and try to get enough, but how do they start doing that? What's in the book that will really stand out for someone that skims through it?
Yeah, so I really wrote this book. I've had over 2,500 calls now with high net worth investors, average net worth of 2 million, some as much as 10, 20, 50 plus
Mhm.
million. And, I've just had so many conversations where people just like, how do I get started? What do I do? I know I should be doing real estate. I've got a little bit of money. I've got a million, 2 million. I've got some money in my retirement. I've bought a rental house or two rental houses, but like, this doesn't seem like it's working for me. And this idea of passive income, people say, oh, it's buying rental houses, or it's doing an online business, or it's online stock trading. And none of those things are actually passive income. Those are not passive, because if you own, like, and this is where I was at, I owned, four rental houses, but I realized if I couldn't 10x the strategy very quickly, what I was doing without creating another job for myself, it wasn't actually passive income. Right. So if I couldn't go from, four rental houses to 40 rental houses almost overnight, because of all the work it would take, to acquire, to get them under contract, to fix them up, to get them ready. And even if I wasn't the one managing them, it was a ton of work. And so I realized there's a big step to be able to do that. So I think for a lot of people, just realizing that passive investing actually involves, the work is on the front end. It's not, nothing's fully passive, but you're doing the work on vetting a team, like a great group like yours that does hotels and other types of investments. And you'll say, well, who is this group? And there's a whole funnel of how you kind of vet both, the market. I start with the market. What's the specific market? So for example, hotels, what's the market for hotels in this specific market? And what are the pros and cons? Then to the operator, who is the operator? Is this a rinse and repeat what they've done before? Or do our values align? A lot of things kind of around who the operator really is and how it relates to this deal. And then you come down to actually what the deal is. Does the deal actually help you with your specific goals? Now, if your goal is you do want to fire yourself, then you need to start working on your passive income, which means cash flow. It's not just making money someday; it's making money now, right? It's making money this month and this quarter. So I think for people, I think in the book, it just kind of really helps people to clarify what their goals are. And then, if you've done a little bit of real estate, you've done some single family, multifamily, you've done some different things. How do I get into other asset classes? There's a system in there on how you evaluate, any deal of any asset class. And it just is kind of the same model that I just mentioned about starting with the market, whether it's car washes or businesses or whatever it is, and then kind of working down to what the actual deal is through the operator.
Do you recommend I pick up your book, I read it, and it's just like there's just I don't even know how to begin. Yeah, he's talking about I need to be this passive income guy and I need to be the general partner. I need to just get a JV agreement going or family and friends and and maybe this is part of your mastermind, but how do you get them to actually understand? Because someone's going to read your book and say, oh, okay, you know what? I'm going to go to legal wherever website, download a syndication paperwork, LLP. I have no idea what's in it, and I'm going to just start raising money. You know,
Yeah. Yeah.
so
Yeah. How do you do it? Yeah, I mean, I think there's really a couple options. I think when people start, I think it's really, do you want to be more active or do you want to be more passive? And that's, the question. An active investor is somebody who's raising money, who's doing deals, who's finding them, who's operating them. It's or wholesaling, flipping. All those things are very active. What I do is active. Even though I talk about passive investing, I'm more active. I'm also a passive investor, which basically it really what passive investing is designed for. And I think this is kind of the good way to look at it is, do I have more money than I have time? If I have a decent net worth, if I have, for example, I have a doctor who, has a net worth of $5 million, he's only in stocks and bonds. Well, that's a great candidate for somebody to get involved in passive investing. For somebody with a $5 million net worth to put 50 or 100,000 in a deal is not the same as somebody who's got a $300,000 net worth, right? It's a totally different kind of ball game. So the person with $300,000 net worth, they may have more time than they have money, or maybe they're busy. Like for me, I was busy. I didn't have a big net worth, but I made the time. I said, I'm going to make the time to go learn this and scale it because the skill itself is so valuable that I can learn, I can grow. I was able to 20x my net worth, 25x my net worth to multiple seven figures within 4 years, right? So it is possible, but it depends kind of what you want and what you want to do. The biggest thing I would say for most people, there's like two things. I talk about this in one of the chapters. I think it's chapter 9. It's that what's the rocket fuel that gets you from here to there, whether you're a passive or an active investor. It's really two things. And they sound very simple, but they're incredibly profound. And there's a quote that I love that talks about this, but it says, you'll be the same person 5 years from now, except for the books you read and the people that you meet, right?
Mhm.
The books you
Yep.
read and the people that you meet. So what is that? That's education and that's networking, right? So it doesn't have to look like books. It doesn't have to look like just, hey, I just met people to think, but it's like getting out to events, getting out to conferences, joining masterminds, getting in a place where you can. And I've literally I've had a conversation with somebody at I went to a $7,000 week long cruise 6 years ago, and then I pitched somebody on an idea, and he said, "That sounds like a great idea." I probably made $1 million off of that one conversation and the work we did over the next 18 months. It was unbelievable, right? So that happens, and then the education side, going and learning, reading the books. I have a huge learning goal every year. Last year I read 90 books. My goal this year is 90, but I'm hoping I'm on pace for over 100. So like I just know that these are things that people that are wealthy and people that are doing, they tend to really invest in themselves and they really invest in building networks. Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, he said most people look for work or look for a job. Wealthy people build networks, right? So if I'm somebody who's building networks, if I'm talking to you, Mike, and I say, oh, Mike, you should connect with my friend over here. It's like that's very valuable to you, to them, and you'll remember that, right? So I think that if we can be people that are connectors, we can be people that really provide value to others. That's a way to really grow your wealth. So it works actively when you're looking. Like I said, I went and I found a partner. We raised a bunch of money together. It also works for passive deals. I found some amazing passive deals just simply by being somebody who was in the room, who had a connection to somebody else, who invested in a deal, and it turned out amazing, right? And this, not every deal turns out amazing, but times it turned out absolutely phenomenally well, and that's because of the people that I knew. So I think those are two things that go hand in hand.
Yeah, and ladies and gentlemen, that's didn't even have to pay for that knowledge that
Yeah,
Bronson just gave you, but it is one of the probably the thing that is just paramount for gaining wealth, and the networking is so important. I try to schedule a lunch or two every week with people that it's like, I haven't heard from this person for a couple, months or 6 months. So I'm always having lunches. I'm always taking people out. Um, join social clubs, the Rotary, the Lions, it's where people that have money spending their time. Uh, golf membership, if you country club, I've probably gotten more investors by golfing
yeah,
because then I realized, do I want them as an investor? The way they act on the golf course. And, but it's crazy, I'm golfing at 9 a.m. or 10 a.m. on a Tuesday, and they're like going, "You're too young to be retired. What do you do?"
yeah,
Well, let me buy you a beer, on the
yeah.
19th hole, and let's. So that networking is just absolutely phenomenal, and always gaining education is paramount. So let's talk a little bit about how you educate people in the mastermind. And um, the term mastermind is kind of like one of those overused terms. I get invited probably
Yeah.
to 10 masterminds a month, and
Yeah.
and some of them are like going, that's not really a mastermind. But let's talk about your mastermind a little bit and the
Yeah.
benefits.
Yeah, so the term mastermind, it's interesting. It comes from a book by Napoleon Hill, Think and Grow Rich, which I mean the same last name. He's not related to me, unfortunately, but he talked about when you bring two or three people together or more, and you kind of get around a problem. There's this kind of mind melding or kind of come together on something. And he talked about examples of Henry Ford would do this with Rockefeller, with other kind of giants of industry, and they just get together and talk, and it's like it's amazing what you could learn and you can kind of help solve. And so yeah, it's been said, how you treat your network is how you grow your net worth, and it really is true. So again, if I want to change, there's another quote by a guy named Jim Rohn, who is a motivational speaker, and he said, "You're the average of the five people that you spend the most time with." And so if you're the average of the five people you spend the most time with, it's almost in every area of life. If I look at my health or my spirituality or my wealth, you could probably see the people I spend time with. And I could probably guess if I just looked at the five people, what their net worth is that are around you or around our listener, or even health wise. I could say, okay, these are your health habits. This is kind of how much you're worth. This is what you're doing. So if you want to change that, you have to really intentionally get in rooms that are, people the net worth is 10 or 100x of where you're at, or people are, because they're just going to like, even with their little comments that are like little sidebar comments, you pick up one thing and it can absolutely change your life. And I see you smiling because I know you've experienced that too, right? It's
Yeah,
like stuff that
absolutely.
we didn't even think was possible. I mean, there's this. I'm writing my second book now called Rich Brain, which is how the wealthy change their brain to change their bank account. So based on all these interviews, what are the mindsets around wealth? And the thing in our culture, Mike, is that most people think that you're either born with wealth or you're not. If you look at like people will say it's about
Yeah.
60%, 65% would say, well, yeah, it has your natural advantages, your networks, or your health, or maybe you were born with a silver spoon in your mouth, but in reality, it's 86%, according to a study from Fidelity Investments. 86% of millionaires are self-made, which means they did not were not gifted. These are learnable, teachable things, and so that's the
Mhm.
encouraging thing. So all that to say is that we gather a group of investors and high net worth folks and credit investors and just say, hey, we want to learn. We're around personal development. The problem with people once you get a net worth of over a million, couple $1 million, it's hard to talk about money with people because you talk to family about it, they're like, I mean, that just kind of creates problems in general. You talk to friends about it, they think you're crazy. Why don't you have a money person and a stock person? If you're doing some of the stuff like this, it's like it's hard to find people that actually want to talk about money and don't think you're crazy. So you get people in the room that are the same kind of crazy and they're doing big things. And so we have investors in our group that are worth 2 million. We've got investors that are worth 50 million. And it's like you get around, it's just like one of the conversations, for example, we had was a lady who came as a guest. She had 30 or so single family houses and she was worth about 10 million and she only had 400,000 in debt on it. So she had very, she had 96%, like very, like 4% loan to value, very low. So she was sitting by a guy who had raised money and been a part of 8,500 units. So he's a syndicator. Another guy, kind of by himself, done about 2,500 units. And I just asked him. We're all sitting at the table, and I said, "Hey, what do you think? Well, what do you think would be the right amount of? Should she take out more debt? Do you think she should sell them? Do you think whatever?" And just had a great conversation around that, right? Of like, well, maybe a 50% leverage. You could go do this. You could do this, and like the whole return on equity conversation came. Well, if you have all this money tied up here, you're probably making a 2% annual return per year. Well, what if you could get a 5% or a 10%, get a little bit higher without taking on a lot more risk? So those are the conversations that we have. So it's really designed for getting people in the room that are kind of, the same kind of crazy in a good way, that are ahead of where we're at or peers. And some people won't do it because they want to give back. So that's why we created the Wealth Forum. It's been a lot of fun. So it's been going for about a year now and we have a small handful of people in it, but it's been a real blast.
And that's an important lesson, everybody. It's about surrounding yourself with the same crazy, uh, because there's so many people out there that want to put you down and say, no, you can't do that. No, the interest rates, no, this, and they have no idea how we think. And they're like, why would you ever buy this now? The economy. And I'm like, I don't care what it costs. I just want to know if it cash flows.
Yeah.
And you try to get that to them, and they just spin. And
Yeah.
I'm like, I'm wasting my time in this mastermind because most of the people haven't even bought their first deal yet,
Yeah.
and or they're the analysis by paralysis type of a people,
Totally.
and all they want is free advice from me, and I'm like, I'm not learning anything here.
Yeah.
Um, and
Yeah.
so it's very, very frustrating to find that mastermind and one that is not $25,000 to get into, $30,000 to get into, 50,000, there's some that are just really expensive. And, is there an ROI? So, I'd like to have that 30-day trial,
Yeah.
on some masterminds to see what you get. I just don't want to give the creator of that mastermind 50 grand and not get anything. And that's everything in life. Um,
Yeah.
are you doing anything? Do you have any open funds, any open syndications,
Yeah. Well, right now I don't know if it'll be
that
open
you can
by the
talk
time.
about?
Yeah, I don't know when this will go live, but we're always doing deals. So we've got our investor club. So usually about once every month or so, we'll have something we'll launch. We've got a couple oil and gas deals that we're wrapping up. One's an oil and gas drilling deal, which is a great tax play. Usually those are unique because you get about 85% ordinary income tax reduction. I'm not a CPA, but generally people can take a pretty good tax against ordinary income, which is amazing. And then another one's more of a land play where it's we own the land where there's existing wells and that's cash flowing pretty heavily even from the beginning, and then we can reinvest. It's kind of a unique place when you own the land. You get all the data, for example, from 140 wells on one property, and we can say, hey, we can participate in certain wells going forward just in a certain region. So if it's like the Northwest area, this area is really booming. If anybody drills another well there, we want to put money in that because that's where the money is. That's where we see what's coming in. So we have some real upside and things like that. So yeah, so we're continually doing things. We have our debt fund that we're doing. We're continually looking for more business opportunities, but like you, we're pursuing opportunities that make sense. I would say we're positive real estate. We're doing more debt fund related stuff, but I think there will come a point to be more of an equity investor on things. And the problem is sometimes if you wait too long, it can be like it's a good time. And then when everybody thinks it's a good time, so like looking back, like, and you've seen this as well. The sometimes the worst time to raise funny is funds is the easiest time to raise it, which means like when everybody's super hot on it. We've had times we've raised $8 million in 24 hours, and it was like and the deal was okay, it turned out fine, but it was like looking back, there were some times where it was not the best time to raise, but everybody was super excited about it. So it's like this whole like, if you want to be a contrarian, it may
Yeah.
actually be a very good time to do real estate right now because it's just looking at the long term and getting in and I'd rather even pay a little more and be able to refinance later if rates come down and it's just hard to say where things are going to go from here.
Yeah, and once you get educated, everybody, and read those, I'm not going to read 100 books in a year. Um, like Bronson, maybe 20. Because my ADD will start going, I can't do it. It's crazy. Um, so let's talk about a couple things. Your mastermind, is it online? Is it only in person?
Yeah, so our mastermind, the Wealth Forum, we do it. It's a combination of online and in person. We do once a quarter. We do a in-person event. The next one will be in June in Orange County, and we're really excited to be. We do a quarterly in person. So we'll have about probably 30, 40 people there. We have some guests and speakers that'll be there. It'd be fun to have you at one of our events coming up. We actually were just in Arizona recently. I didn't know. I think this is after
No.
we had connected. So I know you're not too far over there, but yeah, so that's kind of what we do. And again, it's really, we kind of create specific goals for each person. So it's like, hey, what would be a win over the next 12 months for this person? It is high ticket too. So we try to really make sure that the funny thing is like, I've read, and you mentioned this kind of what you shared. I used to run a real estate meetup here in LA in Pasadena for 6 years. And you'd get, 60, 70 people in there. And there might be a couple people that like, but you know who they are, right? That are high net worth. And it's like, it was hard. But when somebody's paying thousands of dollars to be in the room, they're going to try to find a way to get value. They're trying to spread value, and it's also less of a deal for them to be there, but it just limits who's in the room. And so we're just really trying to provide value for people. But I think whatever people do, I mean, I'm in masterminds. I'm in multiple masterminds. Of course, I run a mastermind, and I think it's just a great way to really put yourself in bigger, better rooms. And also, whether it's finding specific deals, it's finding partners. I mean, I've heard about deals that someone just was the person to call, and this person knew this person. They were able to. This was a few years ago. They closed a real estate deal. They need like, I think it was like $1 million or a couple $1 million to just go into an account to help with the closing because the seller of the property was going to keep 2 million in equity in the deal, but the lender wanted to see the $2 million actually be there. Right. So it was like they had to, okay, need $2 million. So this person made like a 5%. It was like 100K just like overnight for putting the money in the bank to let it close. So that's a very unique deal, right? That's like if you
Uh,
annualize that number, it's ridiculous. But there are opportunities like that come up where again, if you're just in the right rooms, you're around the right people, things will come to you. And if you get a reputation of somebody who kind of is a straight shooter and you do what you say you're going to do, and I mean, that reputation really is huge. And so I think all those things are important. And so I love, paying to be in great rooms because I know if I'm paying, then
Yeah,
everybody else is paying too.
that's right. Now let's talk about kind of a hot topic is debt funds, and you're starting to see that a little bit more in our circles. Explain to our audience what is the debt fund? Are we now all of a sudden we raise money and we're a bank, and then or
Yeah.
how does that work?
Yeah. So yeah, debt funds are interesting. It is in a way becoming the bank. I think there's different types of debt funds. So not all debt funds are created equal. And I didn't really get, honestly, even being a finance background, I didn't really get this as much, but there's debt funds that are more first position, which are the safest funds. So it's similar, you think about your house. If you have a house that, maybe you put 20% down, the bank has 80%. They are the ones that own that. That's a first position note. Any other loans or contract liens are secondary to that. So the bank or the first lender has to get paid everything first before a second or third lender gets paid. So it's different than a lot of groups that come in with flipper funds or other types of second position or mezzanine debt. And that's where I always ask, it's a great question for somebody. This may save somebody a lot of money. Ask, is it a first position debt fund? And a lot of them are not. And that's where you actually, to get those, a lot of times you have to actually partner with a lender. You've got to find some context. So we've got a lender that we've worked, that has been in the space for 20 years, small commercial properties. They're doing, $5 million or less properties, and then it's usually 50 to 60% loan to value. So that means if this, was a $4 million strip mall or something like that, somebody, the buyer brought 2 million of their own money. So if they were to not pay, we would take over at a cost of like half the price, right? Just about having maybe half or a little more than half the price, and just take over. Either we immediately resell it, or we would operate it for a while. And so we have this in a diversified pool of different of loans, and so people get just steady cash flow. It's monthly, depending on how long they tie it up. If it's for a year, if it's for 6 months, if it's for 3 years, and depending on how much they put in and how long it is, it's typically a little bit more. But we're seeing some just amazing rates. Really, we're finding some of these debt funds are paying like equity was a few years ago. So we're seeing it's not uncommon to see 10, 12, 14, even up to 15% in some of these debt funds, which is phenomenal because you're basically in the safest position in the real estate deal, like literally the safest position. If no one gets paid, at least you're going to get the land, and then you can figure out what you're going to do with it. And then having diversified across a pool of loans. So I think those are different ways to do it. And there are other funds or debt funds that can work as well, but I do like first position. I do like being with an experienced lender, but I think there's definitely a lot of opportunities in the debt fund space now.
So, people go to ladies and gentlemen, Bronson Hill, bronsonequity.com. People interested, they want to get to know you. What are they going to find when they go to the website?
Yeah, well, I actually have a good way to connect. I've got a free gift for your audience, Mike. I've got a guide. We've talked a little bit about on this episode about inflation, and I was kind of looking at how much things cost and how everything is way more expensive, 50 to 100% more. And it's like every time you go to the pump, every time you go to the grocery store, there's some price has changed, something's higher. Like, it just seems like things are going up. So how do you get on the other side of the equation and use inflation to your advantage? So I wrote this guide. It's how to use inflation to your advantage. It's about 30 pages. People can text the word inflation to 33777. So if you just get on your phone and text the word inflation to 33777, I'll send that to you for free. And that'll let people know about our offerings, what we're doing. If they want to join our investor club, all out there. But I'd love to give that gift to your audience.
Fantastic. Everybody text it, get it. It's knowledge. Bronson, is there anything else you'd like to leave us with that perhaps we didn't go over today?
No, this has been great, man. It's been a lot of fun. Look forward to connecting more with you, Mike, and we look forward to hopefully maybe doing some business together in the future. I love what you're creating as the Richer Geek, and just love what you're creating for your audience. So thanks for the time. It's really great to connect with you and with your folks today.
Absolutely, Bronson. Thank you so much for coming on the Richer Geek podcast. Have a wonderful afternoon.
Thanks, brother.